Hey guys, my name is Michael Chin, and in this video, I'm excited to share with you guys one of my favorite earnings strategies that I use to bring in a consistent income. I'll show you guys one of the live trades that I took using this strategy and show you guys how the trade setup works. If you're interested in learning more about options, please feel free to subscribe to my channel where I'll be posting more strategies like this, as well as other stock market and options related content. Okay, so let's get on to the strategy. So Nike had earnings 2 weeks ago, and I saw this as a great opportunity to sell an iron fly. So I came in and sold an at the money iron fly, which means that since Nike is trading at around $101, I went and sold the 101 iron fly. As you can see here, I was risking about $800 for a max profit of $2,400. Now, the next day, Nike was trading in our favor, and I was able to make a profit of $1,100. So I risked $800, and overnight I was able to make $1,100. That's a 130% gain overnight with this one options trade. So why do we take this trade? Well, first of all, we want to take advantage of theta decay. If we look back at the contract here, we can see that there's only 1 day left on the contract. And usually the bulk of an options premium will erode on the final day. So if we see here, the two sold options that we have as part of the iron fly are going to get hit hard by theta, especially overnight. And secondly, what's probably the more important thing that we're taking advantage of is the IV crush. All right, so when we sell options, we want the IV to go down. IV stands for implied volatility, and the higher it is, the higher the option will usually cost. So as the IV goes down, the price of the option will also go down. Now, as an earnings trader, the one thing that we always know that will happen after an earnings report is the IV will go down. That means that we're automatically making money off of this IV crush no matter what happens to the stock. But before I show you guys how badly IV can go down before an earnings report, I want to show you guys how much damage theta decay and IV crush has on an options price overnight. So if we take a look here, we can see that the price of these two sold options that we have are $219 and $227. Now, what's going to happen to them overnight? So when we come over to the morning panel, we can see that these two options are now trading for $3 and $157, right? $3 and $157. So they were $220, and now they're both trading for less than the price that they were trading yesterday. Even though Nike went down in price too, right? Nike went down in price, and you would assume that the sold put would lose money, right? Because it went in favor of the put. Well, absolutely not. IV crush and theta decay are not something to mess with, and they can really do some damage on your options contracts. So we, as the seller, gladly take this in and take our profits and call it a day. So by now, I hope you have a good understanding of how the structure of the option strategy works in our favor. But now we have to understand how these components actually play out for us. Well, the first one was theta decay. That's just time. It always works in our favor when we're selling an option. But the second one, remember, IV. IV can go up or down, but during earnings, it's the one time that we know for 100% fact that IV is going to go down. Now, and that's the essential thing about this trade. We know IV is going to go down, so we are able to take advantage of it. Now we can actually come here, I'm on the Thinkorswim platform, and we can actually prove that point. So I have a chart of Nike here, and we can see the past earnings reports down here on the x-axis. I'll bring up the studies, edit studies, and this is actually a free study which you can look at yourself, and it is called Imp Volatility. This will show us the implied volatility over time, and as you can see, every time there is a report, implied volatility goes down, report down, report down, report, down. And we can do this for any stock. It's not just Nike. We can go look at Microsoft. So Microsoft, we can see here after the report, down, after the report, down. We can go to Amazon. We can see here after this report, down, after this report, this one here, sorry, this one, down. So implied volatility is always going to go down, and that's something that's going to work in our favor. With that in mind, we already have a clean setup that has a positive edge. You could actually just trade iron flies on every single earnings report and you'd come out ahead a winner. But for me, I like to have a higher win percent rate. So that means that I'll be looking out for other factors that could potentially contribute to a higher edge. So if we come back to Nike here, one thing that I like to look at are the past earnings report. I like to see if the market makers were able to efficiently price in the earnings report. That means that the price will barely move or only move a few points or so after the earnings, which means that if we did sell an iron fly, it would be profitable. So if we take a look at some of these past earnings reports, this is kind of a big move, but it actually sold back down. This one here, we saw it barely moved. This one here, that's a pretty big move. So if we did sell an iron fly there, we would probably lose in this case here. This one gapped up, but then sold back down, which would be fine for our iron condor. This one right here, it sold down, but then actually rallied back up. Perfectly fine for us. This one's a big outlier here. We wouldn't profit off of this one. And this one looks like it barely moved at all. So of the, 3, 6, 7 earnings reports, 2 of them would have gone bad for us. And when I see that, that is a great sign for us to be selling an iron fly on this next report here. And on the flip side, we can actually see what a bad stock would look like. So if I were to type in a stock like Skechers, if we take a look at this stock, the market has no idea how to price in these options. These things fly all over the place and no one knows where these prices are going to go because there are so many unknowns with Skechers industry. So with this one, I would never sell an iron condor here. I bet they would almost never be profitable. Yeah, I don't even see, maybe right here they'd be profitable. So you'd be profitable 1 out of the 8 times that you tried to sell an iron fly on this stock. Another factor that I like to look at is the open interest. So let me actually take us back to the Nike options chain. Okay, so here we are back at the Nike options chain, and I'll show you guys what I look for in open interest. So first of all, what is open interest? Well, that's the number of contracts that are currently open on the market. So right here, we can see that there are 4,000 of these 97 half calls on the market. And what I like to look for is high open interest. So we can see that there's some high open interest here and here, 14,000 and 13,000 contracts. Now, what that tells me is that there's probably a hedge fund out here that sold a whole lot of calls on Nike. They probably contributed to around 20,000 of these calls, right? There's no way that a average investor like you and me is going to sell 20,000 calls. So hedge funds have come in here and they have sold 20,000 call options. We can also look on the put side for the same thing, and we actually don't see a whole lot of high open interest over here. And this is kind of a tangent, but when you see this probably means that the hedge funds are all betting for Nike to go down, right? They've all sold puts. They're not selling any calls. They only think Nike is going to go down, but that's a whole different kind of trade, and I'll talk about that in another video. Anyway, back to these 20,000 sold calls. Well, what's going to happen is that if Nike were to rally a bit, let's say it rallied up to 102, then all of these call options will be in the money and the hedge funds will not be making any profit on these contracts that they just sold. So what are they going to do as a hedge fund? Well, they're going to try and manipulate the stock to the best of their ability. They're going to try and unload some of their own shares to bring the price back down to somewhere around probably 99, where all of these options will expire worthless. And what does that mean for us? Well, since we know that the hedge funds are going to be there to try and manipulate the price back down to 99 or 100 so that these options contracts expire worthless, we know that the Iron Fly that we sold at 101 will benefit from this. Now, this isn't perfect, right? Nike could have stellar earnings and the price could just blast off. Hedge funds aren't going to be able to manipulate that price and we will lose. But this is one area where open interest can help us in the event that, Nike moves up 1 or 2 points and we need it to come back down, or Nike moves down 1 or 2 points and it needs to come back up. So open interest is just another one of those small factors that benefits us. All right, so I hope you guys have a good understanding of how this earnings strategy works out, because earnings are coming back in early January. So you want to have a good understanding of what's going on here so you yourself can be making those 100 to 200% gains overnight. Remember, it's an Iron Fly that's already profitable, and then we're adding in some technical analysis to give us a higher edge. If you have any questions about what I talked about in this video, please feel free to comment below and I'll be happy to help you. Thanks for watching and happy trading, guys. See you at the next video.